We are lower across the board. We're off the lows, but we're still down across the board. Rates, though, today are not lower. 383 is where the 10-year note yield currently sits. So we're going to watch that. We're going to get into all of the market stuff, PPI and everything else. But we do have new moves from the committee today that I want to tell you about first. Josh Brown, who's been active lately, pretty active. You bought DocuSign. I want you to tell our viewers why you bought DocuSign.
Good question. No, look, this is for me a situation where I've never owned the stock. I watched it run to 300, and then I watched it fall to, 40-something. Now it's back in the 60s. They don't report until March, I think, 13th or 15th. So this is the kind of thing that I normally do. I buy a very small amount, wait for the big bad news. If it's an overreaction to the downside, I add to it. And if it's not and the stock continues to break out, at least I've got some position on. It's the way I've always bought very volatile stocks. And that's what this is. But I think what's important here is the company this morning put out news that they are further reducing headcount. They know what the playbook is. They've watched all the other technology companies do it. DocuSign is a verb and a noun in modern society. Even though there are competing services, we refer to those as DocuSign. I think they have an enormous business, a sustainable business. There is some question about whether or not they have an enduring competitive edge, and that's why the stock has come down as much as it has. But they are still growing in the mid to high teens, double-digit growth. And I think this is a stock that, this is a consistent theme for me right now. It got thrown out with the bathwater. People were calling it a stay-at-home stock. It's very stupid. I have 20 people in my office right now. We're still using DocuSign. It's not a stay-at-home stock. I think it's a great business, and when they get to profitability, which is coming sooner rather than later, I think they'll have a newfound level of respect. So it's the start of an investment. I'm not calling the bottom for the stock. It may go lower. I'll add to it if I get an opportunity.
I mean, you can't call the bottom. It's already 70% off of its low, right? Now, I want to ask you.
I mean, it's had a nice.
Buying it here, buying it
move.
now.
That's right.
Can they get rid of the notary?
But I mean, what I'm saying is, yes, it's already had this great move, and you're undeterred by the fact that it's already come 70% off of its low. Josh.
Well, whatever has happened in the past doesn't really make me any money, in the future. So, of course, in a perfect world, you're sitting there trying to buy the absolute bottom in stocks and sell the absolute top. But that's not really what I'm attempting to do. I want to be an investor here. I want to give myself the opportunity to buy more if the stock price goes lower. And I want to follow along the company's progress as it gets to what I think will be positive free cash flow, positive earnings, and it will no longer be considered one of these high-growth, no-earning stories. I don't think you can wait for that. As we've seen with several other companies in this group, I think you have to say to yourself, which of these companies has a business that I would want to be invested in 2 years from now, 4 years from now. It's not a trade, for me at least. I know there are people that are trading it,
I got
but
you.
that's not how I'm looking at it.
The other piece of business I want to get to before we get into a broader conversation is, Jim, you're going to buy Oracle today, which Josh, I'm sure, is happy about, and maybe you got the idea in part from him buying it the other day. Why Oracle?
I'm going to tell you this
Actually, now I'm going to sell it.
Why Oracle? Seriously.
I didn't mind the endorsement. I mean, it wasn't Josh. My team's been looking at this for quite some time. But here's the answer to your question. Here's a narrative. You remember on Tuesday, I told you I sold Salesforce. I was underweight tech going into that. Now I'm really, really underweight tech. And I don't want to be that underweight tech. I don't want to be one half the market weight, when tech is like 24%. So where am I going to buy it? Listen, I hope, Josh, you make a lot of money in DocuSign. It's not my cup of tea. You know where I run. I run to the cheaper stocks. For better or worse, I am who I am. I was uncomfortable with Salesforce for that reason. And I'm happy being in Oracle. This is a stock, by the way, that for many, many years, like most of the last decade, nobody gave a hoot about it. It was totally unloved. Last couple of years, sentiment has started to pick up. It's attractively priced, roughly 16 times next year's earnings, PEG ratio of 1.3, 1.4% dividend yield. This is my kind of stock. So when I look at where do I want to be in tech, I want to be in value tech. I hope everybody makes money. I'm not taking shots at anyone. Value tech is where I want to be. You see it working with Cisco today. You see it working with some other stocks like that. I know Steph was on that day, Scott. We talked with her a little bit about IBM. I've been burned too many times in IBM. I'm not going to do that. I need a fresh start. Oracle is there.
Okay.